Welcome to the deep dive. Today we're looking into something, well, pretty remarkable actually. Birla Corporation Ltd, BCL, just dropped their Q2 results.
That's for the quarter ending September 30th, 2025.
Right, Q2 FY26. And somehow they've managed this huge profit turnaround.
Yeah, right in the teeth of a really tough market for cement. It's kind of a paradox.
Exactly. So we're digging into their official press release, the unaudited financials they sent to the exchanges on November 7th.
And the context here is key. We're talking subdued demand, weak pricing because of competition, even disruptions from GST changes. It was messy.
It really was. But BCL, they posted a massive 71% jump in consolidated EBITDA.
And maybe more strikingly, they went from a net loss last year, what was it, 25 crore?
Yeah, 25 crore loss in Q2 last year to a 90 crore profit this quarter.
So our mission today is basically to figure out how. How did they pull that off? Was it pure cost-cutting, smart sales, something else entirely?
Maybe that jute division playing a bigger role. We need to unpack the drivers behind this resilience.
It looks like efficiency might be the hero here, but let's see.
Okay, let's start with those consolidated numbers. The big picture. Consolidated revenue was up 13% year-on-year.
Which is decent growth, hitting Rs 2,233 crore.
But that EBITDA figure, jumping 71% to Rs 332 crore, that's where the real story seems to be.
Absolutely. It means they got much better at squeezing profit out of each rupee of sales.
And that flows right down to the bottom line. If you look at the first half of the fiscal year, H1 FY26.
The change is even more dramatic. Net profit for the half year hit Rs 210 crore.
Compared to just, 7 crore in the first half of last year?
Exactly. A 2,900% change. I mean, that's not just growth. That signals a major operational shift working across the company.
And their release points out this improvement wasn't just cement.
No, that's right. It came from both the cement division and their jute division. So two turnaround stories happening at once, really.
Okay, let's tackle cement first. That's the core business, and like you said, the headwinds were strong.
Yeah, really strong. The quarter saw excessive rain, which always slows construction. Prices were weak, competition fierce.
And then those GST changes in September threw another wrench in the works.
Created real market disruption, yeah.
The press release gives specifics on the price drops, too. It wasn't minor.
No, not at all. In the central region, prices fell Rs 3 to 5 per bag because of competition.
And Telangana was worse.
Yeah, Rs 7 to 10 per bag down in Telangana. And the non-trade segment got hit hard by those GST shifts.
How hard?
Corrections of Rs 10 to 15 per bag in central, western, and northern India. So pressure from all sides, really.
Okay, so amidst that, how did BCL actually grow cement sales volume? It was up 7% year-on-year.
Right, to 4.2 million tons.
And crucially, how did they boost the operating profit margin in that division from 9.8% last year to 14.7% this year? That's a big jump.
This is the key metric, I think. Their realization per ton, so what they actually got paid by customers, only went up by about 3%.
Only 3%.
Okay.
To Rs 4,845 per ton.
But, and here's the kicker, their EBITDA per ton jumped 54%.
Wow, 54% to Rs 712 per ton.
Yeah, so even though they weren't getting paid much more per ton.
They were making vastly more profit on each ton sold. That screams efficiency.
It absolutely does. They basically managed to shield themselves from the market chaos by controlling what they could control, their internal costs and operations.
And they actually cut operating costs.
Yes, operating costs, excluding interest, actually declined by 2% year-on-year.
Which is pretty impressive given, general inflation, and they apparently had some operational issues too. Unplanned shutdowns.
Exactly. They even had to buy some clinker externally because of those shutdowns, which usually adds costs. So reducing overall operating costs by 2% in that environment shows some serious discipline.
Okay. Immense discipline on costs. But cost cutting can only go so far. What about the sales side? Any smart moves there?
Definitely. They played it smart with both product mix and where they sold it. First, product mix.
Focusing on the higher end stuff.
Precisely. Their main premium brand, Perfect Plus, saw its volume grow 20% year-on-year.
20%. Nice.
And Unique Plus, another premium one though, off a smaller base, grew 28%. Premium cements generally have better margins.
Right, less sensitive to those commodity price wars. And channel strategy.
They shifted focus heavily towards the trade channel that's typically more profitable than bulk non-trade sales.
And the numbers show that.
Yeah, trade channel sales went from making up 71% of their total last year to 79% this quarter. A significant shift.
Okay, that makes sense. Anything else on the product side?
Blended cement, they push that hard too. Sales volume up 14%.
And that now makes up.
Almost 89% of their total cement sales, up from 83% last year. Blended cement is often cheaper to produce, uses fly ash or slag.
So, again, focusing on margin protection and cost. Where did the actual volume growth come from geographically?
It seems quite targeted. Madhya Pradesh and Rajasthan were the main growth engines, up between 7 and 11%.
Suggests they focused their efforts where they had maybe a cost advantage or strong market position.
Could be. So the cement story is one of, let's say, tactical precision against market chaos.
Okay, let's switch gears to the jute division then. Birla Jute Mills. You said it also helped the overall profit picture.
It did, and it's quite a turnaround story in itself. It went from losing money to making money.
Okay.
Specifically, it reported a cash profit of Rs 5 crore in Q2 this year,
Compared to...
a loss of Rs 2 crore in the same quarter last year, so a Rs 7 crore positive swing.
How did they manage that in, well, a traditional industry like jute?
Pretty much the same playbook as cement. Efficiency, efficiency, efficiency. Sales volume was up strongly, 55%.
Revenue up 71% to Rs 132 crore.
But the real gains were operational. They got more out of their loom's average production, up 17%.
Okay.
They cut conversion costs by a whopping 20% year-on-year. And significantly, they cut power consumption by 10%.
10% power reduction in jute. That leads us nicely into BCL's bigger picture strategy on energy, doesn't it? Renewables seem key for them.
Absolutely key. It's not just an ESG talking point for BCL. It looks like a core financial strategy to lock in those cost savings long term.
Right. So for the main cement division, how much of their power is renewable now?
Almost 30% in this quarter. That's up from 25% in the same quarter last year.
And they have a target to increase that further.
Yeah, quite an aggressive one. They're aiming for 32% renewable power usage in the second half of this fiscal year, so H2 FY26.
That requires serious investment, but presumably hedges against volatile coal or petcoke prices.
Exactly, and protects against potential future carbon pricing. They're already acting on it, too.
What are they doing specifically?
They've started sourcing power from new projects, 6 milliW of wind-solar hybrid at Chanderia, another almost 7 milliW at Durgapur. Those came online basically in November 2025.
And more planned?
Yes, the board just approved more. A 9 milliW solar project with battery energy storage BESS at Chanderia. That's important for storing solar power.
Right, for use when the sun isn't shining.
And another 5 milliW solar plant at Mukutban. Even the jute mill is getting 2.1 milliW of rooftop solar, expected by December 2025.
So this isn't just tinkering. It's a fundamental shift to lower their future operating cost base.
That seems to be the strategy. It adds credibility to the idea that these efficiency gains aren't just a one-off.
Okay, looking forward then, what's the company expecting for the next quarter, the December quarter? That's usually better for construction, right?
Generally, yes. And management sounds fairly positive. They expect demand to pick up.
Driven by what?
The usual suspects. Government spending on infrastructure, which tends to continue, and potentially better rural housing demand after a decent monsoon.
And they're forecasting volume growth.
They're guiding for around 4 to 5% year-on-year volume growth for the December quarter. They see recovery particularly in the north and west regions.
So if demand firms up, BCL looks positioned to capitalize from a place of strength, operationally speaking.
That's the optimistic view. But
Yeah.
there's a significant...
The regulatory issue, the IPA incentives.
Exactly. This is a major headache hanging over them. It relates to their Durgapur units in West Bengal.
How much money are we talking about?
The total outstanding claim is about Rs 167 crore. It's for industrial promotion assistance, incentives they believed they were owed.
And they had legal rulings in their favor, didn't they?
They did. They won in the Calcutta High Court back in 2022. The state government appealed to the Supreme Court.
And lost.
Yeah, the Supreme Court dismissed the state's appeal in September 2024. So legally, BCL seemed to have secured these funds.
But then the goalposts moved.
Dramatically. In April 2025, the West Bengal legislature passed something called the Revocation Act.
Which did what?
It retrospectively canceled the incentive schemes under which BCL was claiming the money. Basically tried to undo the legal victories after the fact.
Wow. So BCL is fighting that now.
Yes, they're challenging the legality and, crucially, the retrospective application of this new act in the High Court. It's a serious legal battle.
What does that signal, more broadly, that kind of retrospective action?
Well, beyond the Rs 167 crore itself, it creates significant uncertainty for any business relying on state-level incentives or long-term agreements in the region. If rules can be changed backwards, it really ups the risk factor for investment.
It definitely casts a shadow, even with the strong financial performance this quarter.
It does. Though, speaking of financial health, other indicators look good. Their ability to cover interest payments, for instance.
The interest service coverage ratio, the ICR.
Right. That improved massively. It went from 2.29 last year to 5.35 this quarter.
So much, much more comfortable servicing their debt now.
Much stronger position. And their debt equity ratio is stable around 0.49. So financially, despite the legal fight, they look solid.
Okay, so stepping back, the big takeaway from this BCL deep dive seems to be what?
I think it's that intense internal discipline, cost control, operational efficiency, driving that EBITDA per ton up, smart product and channel choices. It built a really effective shield.
A shield against a pretty brutal market environment, allowing them to turn that loss into a solid profit.
Exactly. That internal defense was key. But the path ahead isn't simple.
Right. They're banking heavily on renewables, aiming for that 32% target to keep costs down.
Which leads to the final thought, maybe. For an industry like cement, so capital intensive, so exposed to market swings and regulatory changes.
You like that IPA issue?
Precisely. How long can companies like BCL rely primarily on just being more efficient than the next guy? At what point does the industry need more fundamental stability, both in pricing and, well, in the rules of the game?
That's the big question. Keep an eye on that 32% renewable target and definitely watch how that West Bengal legal battle plays out.
Yeah, the outcome there will say a lot about the operating environment, far beyond just the 167 crore.